Expert Jason Brown joins us live in studio to tell us what's going on with our money. Jason, so good to see you.
Breeze, good to be back.
Yeah, it's so good to be back. So the S&P 500 hitting new all-time highs, Dow roughly 600 points away from all-time highs. I mean, what does all of this mean?
You know, it means exactly what I said before when I was here, which is don't panic. And if people didn't panic when the market tanked, when you look long term, we go higher. And so now that we got the trade war pause, which was, 90 days, and then inflation seems to be getting under control, the market is back roaring and rocking. And so we're hitting new all-time highs, which means not only did you recover anything that you thought you lost, you should be seeing a little bit more money in your bank account than it was in there last year, or should I say in your investment account.
So is now a good time to invest into new things or just expand our portfolio? Any of that? Is now a good time to do that?
So it's always a good time to invest. And sometimes people think when the market's at all-time highs that, it's too late, I missed out. And I think that's the wrong mentality, because that's assuming that the market isn't going to get better, tax cuts aren't going to be here, companies aren't going to figure out how to save money or become more efficient, which they typically do because technology gets better. So I like to say, when you look at the market at all-time highs, are the worst issues currently behind us? We got a ceasefire with the war stuff going on. Interest rates are as high as they're going to be. We got a 90-day pause on tariffs. So for the most part, everything is looking like the next things that can happen could be positive to take us higher.
So we know what's happening right now, but is there anything in the near future that we should be concerned about when it comes to, deciding on things that we should be investing in, things that we maybe shouldn't?
Well, the market is never a 100% slam dunk. Just put some money in there, we'll for sure make money. So there's always something you should be worried about. We got the 90-day pause on the tariffs. What could throw us off is if we come out of this 90 days and we don't get the permanent trade deal, because the market likes certainty. But I feel confident that we will. So that's something that we can pay attention to. You also have the quote unquote big, beautiful tax bill, depending on what side you're on, if it's big and beautiful or not. But that's going to have an impact on companies and how they look at taxes, as well as consumers, how they pay taxes. And then you also have, last but not least, we're waiting to see what the Fed's going to do with interest rates, which could spur some excitement in the housing market. We just saw that interest rates came down to about 6.7%. And there was this report that a lot of refinancing took place in the housing market. So if people can get their interest rates down, that's lowering their payments. That's more money in their pocket, which means more money to shop, vacation, or do other things that they want. So those are some things that we could be paying attention to that could help or hurt the market.
So when we're talking about the market, are we talking about individual stocks, or are we talking about index funds, or both?
A little bit of both, right? So consumers are part of the market, because the more money that we have in our pocket, that's the more money we have to spend or invest and take vacation. So that goes back into corporations, which then help them as far as reporting profits. Those companies are part of ETFs, or exchange traded funds, or part of the overall market, which helps the overall market rise. So we're kind of talking about the complete picture, from the companies to the taxes that they can save, on down to the individuals refinancing their home or saving money on taxes that they then turn around and put back into the economy, which makes stocks go up.
So last time you were here, we were talking about AI and how AI is doing incredible things, and it's the new thing, and we should be on the lookout for it, and it's going to do great. Stocks are going to respond amazing to it. And we have seen that. But are there any other sectors we should be looking out for?
Yeah, so a couple of individual stocks we looked at and talked about before. Palantir was one that we really liked. That thing's, I think, up over 50 to 75% this year. Don't quote me, I don't have the numbers right in front of me. But technology stocks overall have been moving. So people want to look at the XLK, which is the ETF of the S&P 500 for techs. The industrials have been doing really well, and also the financials have been doing well. In high interest rates environments, they're able to make more money. And then in low interest rates environments, more people are borrowing and expanding. So it seems like they're kind of interest rate proof, seem to do well no matter what. So those are three sectors that I think investors should be looking into.
So we just threw out a whole bunch of letters. We said ETF, ETC, ELX. So what does all that mean?
Yeah, so that's a good point, right? So ETF is an exchange traded fund. So instead of you saying, I'm going to go buy Apple, for example, I'm going to go buy Google separately, you can buy the ETF. So the XLK would have an Apple, a Google, an Amazon, some of the tech stocks in it. And so they'll have percentages of those stocks. So maybe 10% Apple, 5% Google, 7% Amazon. So you can buy the collective of those tech stocks versus the individual. And then those ticker symbols is what we threw out there. Those are ticker symbols. So instead of, if you wanted to trade Apple stocks, you could spell the word APPLE out, but on the stock market it's APPL. So that's going to be the ticker symbol. You can trade the technology fund, but the ticker symbol is going to be the XLK for that ETF. So that's what it all means.
How does it compare to index funds, the ETF?
So an index fund is somewhat similar, but the ETF is concentrated into a sector. So for example, if you wanted to invest in the financial sector, you would get the XLF, which is the financial ETF for the S&P 500. An index fund may have a bond, it may have insurance in it, individual stocks, and a whole bunch of other things. It may even have some mortgages wrapped up in there. So it's an index of a lot of different things and not necessarily a concentration.
Wow. Well, you never learn. You never know what you're going to learn right here on Fox 2 Detroit Live. I feel like I just got a deep dive into stocks, and I definitely understand it a little bit more, especially when you throw all those letters out there, Jason.
You asking questions for the people to help them out. I like it.
Jason, thank you so much.
Thanks for having me.
Of course. Wait.